We've all heard that the average 30-year mortgage in the United States has recently hit 7.6%, the highest level since December 1st, 2000. From this perspective, the situation has grown severe, and everyone is now questioning how this market can remain stable. What began as a minor irritation has become one of the worst asset bubbles in financial history. The story of how we got here explains the future and raises serious red flags about the future of this unstable economy. Let's get into it. The upcoming housing crisis will be the worst we have ever seen. And to demonstrate why, we will look back in time. There is clear evidence that what is happening today is far from normal. You see, a lot of people show you a chart like this. They're showing you housing prices throughout history, but this chart has a serious flaw. It fails to capture the all-important aspect of inflation over a 40 or 550-year period. The power of inflation is often overlooked when someone says, "I bought a house in 2000 for $200,000." That doesn't necessarily make it a good deal because $200,000 in the year 2000 is on paper. This person is at home. It is not a real gain. Thus, to quantify a bubble, we must adjust for inflation and demonstrate how much home prices increased. To do so, there is the inflation-adjusted Case-Shiller, which reveals real home prices without boring you to death. This chart will show us how property prices are genuinely inflated without the illusion of a declining currency, and as you can see, we have now eclipsed the previous bubble, which was considered monumental in terms of US history. Indeed, based on the pioneering research of Robert J. Schiller and Carly Case, we have relatively good data on housing prices dating back to 1889. As you can see, 2008 was absurd. The price of a home reached levels previously thought to be impossible to achieve. And while there has been a trend of rising real prices over the last 100 years, today's bubble is worse than what we saw in 2008. But we've lost all sense of normalcy since about 2012. So, what makes me think we'll end up back here? Well, there is a point in this argument where we think the bulls lose their ability to argue against a crash, and it starts with a bit of history. It wasn't all that surprising to see the 2008 bubble start to develop after the year 2000, because interest rates throughout history were high when compared to today's interest rate standards for the last 30 years. We've had a slow decline in rates, which allowed the ingredients for the 2008 bubble to form and collapse. But that wasn't our lesson. After the 2008 bubble, the Fed continued to suppress rates at new records, pushing them down to 2.6% at some point, and of course, they started a new bubble from late 2011 until today. Rose 66% outside of the 2008 rise, this country has never seen such a rapid acceleration, and each time it has occurred, we have seen a crash to bring this phenomenon in line with the historical average. However, if you look at this chart and think to yourself, well, that just isn't enough for us. There is another body of evidence that, in our opinion, is the nail in the coffin. Essentially, it proves that something in the market must be given now. Before I show you this as ECT, please take a moment to help the channel out by hitting that like and subscribe button. Each like is a massive help for the channel, and I would greatly appreciate it if you just took 2 seconds to press that button now. Back to what I was saying. While the housing market is heavily influenced by interest rates, we know that most buyers and investors are purchasing using some sort of loan, typically a 30-year fixed mortgage. Now, without getting too deep into this topic, we know that the 30-year fixed-rate mortgage is essentially a derivative of the 10-year treasury, and this financial instrument dictates what mortgage rates will be. Now, the issue is, what does this have to do with my house and its value? To address this and finally nail the coffin shut, imagine a 10-year treasury note as a special type of paper that the government uses to borrow money, and the way they do that is pretty simple. They take your cash with the promise that they'll give you the money back with a little bit of interest after 10 years. Currently, the interest rate they are paying is 4.5%. Now comes the fascinating part. There is also a 2-year treasury note with an interest rate of 5.02%, which indicates that the government is giving you a greater interest rate to borrow money for 2 years instead of 10 years. Normally, it's intended to be the reverse, which means that the longer the government borrows, the higher the rate is expected to be. When the rates invert like this, you get what's known as an inverted yield curve. Long story short, when this happens, Inverted yield curves are the most clear symptom of a recession. If you look at this chart going back to the late 1970s, you can see that every time the line dipped below zero, it signaled a recession. This was true in the early 80s, early 90s, and early 2000s, as well as in 2008 and 2020. And now, if you zoom in, you can see the problem. This chart is from 2022, so it doesn't reflect current developments, but essentially, we have gone even further into the inversion and are now starting to come back up. The worst, and really when the recession typically starts, is after the inversion is complete and the line moves past zero into positive territory. Look at 2008, it was years after the inversion that the real pain began. Right now we have an extremely troubling situation. The Fed is pushing rates to the brim, but the bond market is sort of calling their bluff. And this is my final point. When it comes to a future crash, the 30-year yield, for example, is the same as the 10-year yield, indicating that investors are beginning to believe that major inflation will occur in the future. We know this because any sensible person would buy a 30-year treasury if the rate was appealing. But it isn't, since there is so much uncertainty about the next few years, which is why buying the 10-year for the same yield is possible. To sell, you need an incentive, which is a rate that is absurd when compared to the 30-year now. If you don't understand this part, it doesn't essentially mean investors will believe that inflation will continue to be high based on these treasury curves, and if that is true, you have to wonder if the Fed is raising rates to beat this inflation. Eventually, you need the Fed to capitulate, and for that to happen, you need a crisis. The crisis is right here in our backyard. This machinery is destroying the housing market right now. Rates are like gravity, and right now we are entering unknown territory. If something breaks, it will bring down this massive house of cards that has been built since 2012, and the bubble that we used to know as the biggest will look like nothing compared to this. Before we wrap things up, let's look at how this housing market crash will affect homeowners and investors. It's not just about higher interest rates and potential economic slumps. It's not just about higher interest rates and potential economic downturns for regular people and smart real estate investors. When interest rates rise, those with adjustable rate mortgages or those looking to refinance may struggle with higher monthly mortgage payments, leading to more foreclosures and a slew of homes on the market at rock-bottom prices. As for investors, particularly those who purchased properties expecting them to appreciate, they may confront new issues as prices fall. They may end up with houses worth less than what they owe and less rental income. So, that's it for today's video. If you like watching this type of video, make sure to subscribe to our channel and hit the bell icon for more updates.